All right, so we're going to do a Q&A. I think once a week I'll be doing these, actually. I get a lot of questions that pile up, and I always say I'm going to get to them, but then I got tabs upon tabs upon tabs. I just always put them in the back burner, and I need not to. So what I'm going to do is I'm going to spend however long I feel like it doing some Q&As, and then I'll email everybody on my email list to let them know that I've done a video on Q&As. All right, so I'll probably do this once a week. This will be good methodology for me to be able to answer people's questions in a timely manner and let you know that I've done that. All right. So if you haven't subscribed to my email list, you can see in the show notes there'll be a thing to say subscribe to my email list. It's free. It doesn't cost anything. Just go ahead and do that. All right. So what we're going to do here is we're just going to take a bunch of questions, just answer them. So the first one, oh, and I was going to say, please do me a favor, would you? If you're going to email me, don't send me a freaking 5, 6 paragraphs. I just had a guy, like 4 or 5 paragraphs, his whole life story. I'm like, dude, look, I appreciate it. I know you want to, you have a right to be heard, but respect my time. I don't have, it's actually kind of frustrating. I'm not gonna lie. I'm like, dude, do you actually expect me to sit here and read this and then try to filter through where your question is? And this is what I learned from Jack Spurko over the Survival podcast. Start with your question first. If there's more details, put them in there. But start with your question first, because if there's no question on the front, the first 2 sentences, I'm just going to delete it. I just simply don't have the time. I know that sounds arrogant. Well, sue me. All right, so we're going to read my man Kelly writes in. So Kelly says he's been a subscriber for years. All right, gotcha. He has reached his full retirement age, and he lives in California. Last August, he began receiving Social Security at $12,530 right there. All right, so remember, he started taking Social Security at his full retirement age. All right, so that's good. That means, and he's still working, which means there is no earnings test on Social Security because he's still working. All right, so again, remember, if you take Social Security before your full retirement age and you still work and you make basically over $20,000, you will lose. Basically what happens is Social Security withholds some of your benefit and they'll pay it back amortized over your life expectancy once you hit your full retirement age. I know that's a lot to chomp on. I get it's confusing. So the point being, if you're working, don't take Social Security until you hit your full retirement age. So he's done that. So kudos. He says, let's see, and then he says, my understanding is that the state of California does not tax Social Security. Well, you can easily look that up, but I'll show you how you can do that here in just a second. I made $77,000 last year from his job and will receive, we talked about $12,500 Social Security. He's single. All right, good. So what we're going to do here, this is pretty simple here. We're going to go to, hold on a sec. I would suggest you go to smartasset.com, all right, and then you click on taxes, and you're going to hit retirement taxes, all right, retirement taxes. So it has income tax calculator. That's not what we're looking for. We're looking for retirement taxes. So my man here is in California. We're going to click on California. And let's see. He says he's got a Social Security of $12,500. We'll say and he's got income, wages. What do you say? $77,000. Yeah. Okay. Gotcha. And he's single, and he's at full retirement age. So we don't have any other retirement income. All right. Gotcha. So and he's single. He's at full retirement age. So that means he's 66 probably. So 2022 minus 66. He was born in 1956, we'll say. All right, good. So let's take a look here. What's his taxes going to be? He'll pay $3,000 to the state of California and $18,000 to the feds. So on a 90, basically $89,500 of income, he's going to pay $36 to the state of California and $18,000 to the feds. Wow, that's a lot. So making $90,000, he's losing $20,000 of that to taxes. Now that taxes does include FICA too, by the way, just as an FYI. I think they even break it down first, don't they? Social Security is not taxed, he says. So there you go. That's the way to do it, man. Just that simple. Now let's just show you what happens if he has, we'll say he doesn't make any money, he takes $40,000 out from his IRA just for simplicity, and then he'll have only $853 in taxes and only $4,336 to the Fed. So anyway, so he's working, he's making basically 90, he's losing 21,000 of that to the IRS in the state of California. So 90 minus 21, he's bringing home 69,000. If he had $40,000 and $12,500 Social Security, that's $52,000. He'd only lose $5,000 to the IRS. So again, it's just in the state of California. It really depends on what you. If you like in your job, stay. But if you don't, it's time to leave because you're just working for taxes essentially. All right, let's see who's next. All right, there we go. We back on here. Okay, cool. Greg writes in, he's quitting his crappy old job. He's 59, wife is 60, and she's not working. I've been a pharmacist at Publix for 24 years. I'm just freaking tired of giving the jab, wearing a mask, and dramatically increasing busyness has been the hallmark of working in pharmacy since the virus entered our lives. Last week, I decided to seriously consider go ahead and retire, but I almost chickened out until I happened to watch your video, How Don Saved His Life by Retiring. I went ahead and emailed my resignation before I could second guess myself. We have no pension, but $1.5 million in retirement savings, no mortgage, 2 cars, no debt, and our kids are on their own. I figure I can safely pull someplace between 60 and 68,000 and live comfortably until Social Security kicks in. All right, right on. That's not a question, but I guess okay, cool. That's good stuff, Greg. Appreciate it, man. You're not the only pharmacist who's emailed me along those lines. That's for doggone sure. Tell you what, I get a lot of pharmacists who said, that's why I did that video on that pharmacy company that was bought out by in California is bought out by CVS. I forgot the name of it, Longs, I think. And it just a lot of people, not a lot, but a couple people wrote in and said, I used to love Longs, it was great, and just big corporate America. Larry writes in, love your videos, that have been so helpful. Do you know of an investment that should move independently of stocks and bonds? I have the Vanguard REIT index. I thought that'd be an independent investment. Nope. But it seemed to move with stocks and bonds. I looked at peer-to-peer lending. Is there a good chance of losing if the borrower defaults? Yeah, I don't know of an investment that moves other than, look, in the down market, Larry, everything is correlated. The government bonds are your only alternative investment when it comes to a down market. It just look historically, but that doesn't mean they won't have some correlation. It just means I just look at 2008. I look at 2001 and 2, by the way. Government bonds did fine in 2001, and 2002, as well as 2008. So they don't move in the same direction as stocks and bonds, even though they are bonds. But you're not going to make much money, I'll tell you that right now. But it does give you that a level of a cushion when the markets do decline, which it's inevitable, man. This isn't being like, oh my goodness, the sky is falling. To not think the market will have another bear market, sometimes it's just silly. In fact, I was just reading an article from Jeremy Siegel, who's perpetually a bull, and he's like, look, yeah, the S&P is going to go into a bear market, and the NASDAQ will go into a bear market in 2022, and the S&P will probably go into correction. I think it's be more than a correction. Correction is only 10%. That's no big deal. A bear is 20%. Easily could go into a bear. So what would you do differently? They say alternatives, timber, okay. Real estate, well, real estate investment trusts are still stocks. Preferred stocks certainly wasn't non-correlated 2008 preferred stocks. The facts are you just got to ride it out, man. And government bonds are your best bet, in my opinion. You can always do options. I don't recommend that, but buy some, pay off your debt is the way to do it, in my opinion. All right, let's keep going. Thanks for the question. Hey, baby. All right, so Chris writes in. All right, when doing your Social Security taxes, I don't understand how a large income would be taxed. An example would be an IRA of $160,000 and Social Security of $20,000. Using the formula, the taxable income would be more than the total yearly income. That doesn't make any sense at all. So he doesn't understand how this works. So basically, you're going to have $160,000 of IRA distributions, and you're going to have 85% of that. So using the formula, your taxable income will be more than your yearly income. No, that's not true. So always remember, my friends. I guess I don't have it up anymore. So what Social Security does, how you figure out your Social Security taxation is you take in this case, $160,000 of income, and because you got to figure out two things. You got to figure out your combined income, what a lot of financial planners call provisional income. And what that does is it tells you how much of your Social Security will be subject to taxation. So number one, how much SS subject to tax? That's your first question that you got to answer. In this case, because he has $160,000 of an IRA, I already know is $20,000, 85% of that will be subject to taxation. I just know that. And how you know this is actually such a simple thing here is you take your gross income, in this case $160,000, then you take your Social Security, but you divide by 2. All right, so you got your $160,000 is your gross income for your IRA distribution. Then you take your half of your Social Security. So in this case, it's $10,000, which means your combined income is $170, or provisional income is $170. All right, so now what we do, we're just going to assume he's married. We have $170,000 as our provisional income, and we know the first 0 to 25%. 25 is not taxed on anything. There's no tax. Again, we're just figuring out how much of our Social Security is subject to taxation. 25 to 34, 50% of that is subject to tax, and anything over 34 is 85% subject. Is that right? Or no, that's for single people. We'll just run it for single people. That's what it is. It doesn't matter. It's because he makes so much IRA income. But that's for single people. All right. So in this case, we know that in here, 25 to 34 realm, that's $9,000 of this 170. All right, so you take 170, the first 25,000 is tax-free. The next 9,000, 4,500 that is subject to taxation. All right. But his issue, so that's going to put, so we got, what's that, 50, so we take 34, that's 25, so $34,000. Now we got 170 minus 34. So 170 minus 34 is, what's that, 136? 170 minus 34. Yeah, 136. So now we have $136,000. And 85% of that is tax. That's probably, I see where he's going with this. That's where he's screwing up. So no, 170,000 is his total AGI. It was before Social Security kicks in. But he's got, his 170,000 is his provisional income, because you take your 160 from his IRA, plus you take your half of your Social Security. That's 170. Let me close this door. All right. So we have 170 as our provisional income. The first 25,000 is not taxed. The next 9,000, 4,500 is subject to tax. And anything above 34,000, 85% of that is subject to taxation. So in this case, we got 136 times 0.85. That means 115. All right. So this guy just completely boggled his mind with his bad math. So basically what's happening here is not our provisional income. So what he's thinking, he's going to say 115 plus, so we got 115 plus 4,500. So he's got $119,500 is what he is thinking is his taxable Social Security. $119,500. And I'm going to do a separate video on this to make it easier, because these numbers are too big. But anyway, I think that's not. So it's the lesser of 85% of your Social Security, which in this case is, because we know it's only going to be 85% of his Social Security, because he's not going to be taxed on $119,000 when he only has $20,000 of Social Security. So come on, let's use some common sense here. So we know for a fact his taxable income will be, or his AGI will be the 160 plus $20,000 times 0.85, which would be $17,000. So in this case, 160 is his IRA distribution, plus $17,000 is his Social Security that's subject to taxation. So you got 177 will be his AGI before deductions, all that. But his income is 180. All right, so his income is 180. They're never going to tax you more than 85% of your Social Security, man. They're never going to do that. So let's keep going. That was a long-winded explanation for a pretty simple answer. So my apologies. All right, so we got Tina. All right. Tina says, "Hey Josh, hope you can help me here. My husband and I are starting our retirement planning. I'm 59. My husband is 53. No kids. I have a bonus coming our way and are weighing out whether we put that against our mortgage, because it takes so much to pay off our house. The mortgage balance is $479. The bonus is $100. We don't have a lot of cash. We have $10K cash and one car loan at $16K. I'd take that $100,000 bonus and I'd pay off the car and I'd stash it all into my cash account. 100%, man. I mean, this is the issue comes to the mortgage. Look, I'm dealing with this. Thankfully, my mortgage isn't as high as hers. Oof, that'd make me nervous. It was. Not anymore. So the question we have to do, stash cash or pay off mortgage. And I deal with this every single day, every single time. I mean, I think about this all the time. I don't have nearly as much cash as I like, but I also have paid a significant amount down on my mortgage. And I'm hoping to do that over the next 3 years, just to be done with this puppy. But I'd still need to put cash away. So what I'm doing is I'm kind of splitting the difference. I'm putting an extra, basically extra 2 mortgage payments a month into my mortgage. And I'm trying to squirrel away some cash. But I don't really even save in cash. I actually save it in my M1 account. So I'm putting $1,000 every 2 weeks into my M1 account. And I'm putting basically $3,000 every month more on my mortgage. So I'm kind of splitting the difference because I want my mortgage paid down. I know it's not paid off, but I want to have some cash there too. In your case, Tina, I just put on cash for the time being because I do think that we're going to have some trying times. And if you have cash, you'll probably be okay. But your mortgage is so high that it's going to take a long time to pay that puppy off. And really probably the only way you're going to do this is by selling, if that makes sense. So just, keep the low payment because I'm sure it's amortized over 3 years. That's probably $2,500 a month just on principal and interest, I imagine. And then you add escrow, it's probably about $3,500 a month. Hold on a second. So just keep the low interest and just knock it out. Try to pay more every month on principal, but you need to get cash. All right, so let's keep going here. All right, we got Marty. Okay, Marty, go to the part. Marty McFly, actually, it's Marty McFly. We plan on retiring using the 55T rule. Okay, when you're showing the bucket strategy, you say move 3 years of money into your save accounts. If all my money is in my 401k, what would that account be? Just pull it out at once to a checking account or take a hit on that income once a year. Yeah, just put it in a stable value fund, man. If you got a stable value fund or a short-term bond fund, just put it in there, 100%. Yeah, don't take it all at once. That doesn't make sense. All right, let's keep going. Now, let's see here 1 second. Nadine says, hi, Josh. As a suggestion, could you explain the difference of index funds, ETFs, and mutual funds for retirement? All right, so in this case, Nadine, ETFs and mutual funds can also be index funds, if that makes sense. So index funds is just a way to invest that you're just basically buying the entirety of a market, whatever market that is, be it the boat manufacturing market, the entirety of the stock market, the government bond market. You're just basically covering all your bases. You're saying, I'm going to buy the market en masse, and that's it. There are index funds for oil and gas, or index funds for stupid clean energies, or index funds for everything. But generally speaking, when people talk index funds, they're talking about the S&P 500, which is the 500 largest by market cap companies in the United States. Or they're talking about this total stock market, which is basically the Wilshire 5000, which is what I own. That's everything essentially. So you're not picking a stock over that stock. You're just saying, hey, I'm going to buy the entirety of the market. That's generally what they're talking about for index funds. So you can do that via an ETF, an exchange traded fund, or via a mutual fund. The benefits about the ETF, and we're not going to talk about taxes here right now, but the benefits, generally speaking, are you can trade them throughout the day. All right, you can sell options on them, all this stuff. I don't think that's much of a benefit for most people. In fact, I'd say for the vast majority, that's not a benefit at all. But that is a benefit on ETFs, is why advisors love them, because they get to trade throughout the day. They can write options against them, the whole thing. They can really parse a portfolio to 12.8% in energy, 8.6% in green. I mean, it's just stupid. The drawback about the ETFs is that every time you buy and sell, it's a transaction. You actually got to go there and make a transaction to buy and sell. You can't put, and this is what people don't understand, you can't say, all right, I'm going to sell. You can do what's called a limit order and all this, but you can't say, buy this, I'm going to send $1,000 to my Vanguard account, and I say, buy this ETF on February 6th at market price. It doesn't work like that. I mean, it doesn't. So that's a drop. You actually got to go in there and transact it. You got to physically go in there and hit the transact button. Now, there are other ways you can do it in terms of sell. You can do limit orders, but just why bother? Mutual funds I like better simply because you just throw it in there. Every month you throw it in there. Every week throw it in there. Every day throw it in there. You don't have to do anything. Now, the drawback about mutual funds, it's only trades once a day. That's it, man. That's it. So other than, and there's no transaction fee, and if it's a Vanguard or a Schwab or something like that. So a mutual fund is very easy to manage. Now, the drawback against people say, yeah, but I get the price at the end of the day. Well, who cares? It's not that big of a deal. So for a novice investor, the mutual fund is always the way to go. You're trying to pull money in or put money in on a regular basis, or you're trying to pull money out. Just be done with it, man. In my opinion. Now, I own ETFs and I own mutual funds. I get it, but I don't like to trade very often, so owning an ETF doesn't bother me. But anytime I put money into it, I got to do a transaction, and I like that. So anyway, I hope that makes sense. Just remember, mutual funds and ETFs are basically the same thing. They own a basket of investments, stocks, bonds, real estate, you name it. The question is, one trades regularly throughout the day. It's like his own individual stock. One trades just once a day, and that's a mutual fund. Just once a day, that's it. An ETF is his own individual stock. You'll have 2 or 3 tickers, just like an individual stock. And it's just ETFs, generally speaking. Bogle, who founded Vanguard, wasn't a big fan of them because he said it's going to increase trading activity, and he's 100% right. So I would just go to mutual fund, total stock market, and throw money into it on a regular basis and be done. All right. Let's see. We got Andy. All right. Andy just got off not Toys R Us. Oh, man, the Toys movie. What the hell was that called? I had a joke lined up and I just screwed up. Andy. Remember Andy was Toys, with freaking, with Tom Hanks, that Toys movie? No, with the Up and Away of Buzz Lightyear. All right, so Andy says, I'm in the last couple of years, maybe few at 55 years of work before retirement. Is it best to take all my pay, only deposit enough into the 401k to get the match to maximize my Social Security in the last years, or keep depositing $26,000 and offsetting my income to reduce taxes and increase my 401k? I have about $700,000 in retirement accounts and no debt. I may retire next year. Just moved south to Florida from Missouri. I'm not actually sure what he's saying. I'm in the last couple of years of work, so I think he thinks that if he actually I think he thinks his Social Security tax, the amount he pays in Social Security is reduced by his contributing to the 401k. It's simply not true. Social Security FICA tax gets first dibs. All right, so just FYI, if you're worrying about putting money into your 401k and reducing the amount of income is taxed to Social Security, don't, because Social Security always gets first dibs. And then you get a deduction. Remember, you're getting a deduction on income tax. That's it. You're not getting a deduction on FICA. So, look, man, if I don't know what he's got, 700,000 retirement accounts and cash. He doesn't say how much cash he has in there. I would recommend, I don't know his circumstance, but I tell you, man, make sure you got cash built up, man. I mean, build up cash, because you're only going to be, the way I see it, man, I would rather pay a little bit more income tax now to have more of a cash bucket, if that makes sense. Hope that helps. All right, so Jim Bob writes in, all right, help me with some math. If I have $1 million portfolio, 401ks, and it's all mutual funds, the only choice you get. If I'm paying an annual mutual fund 1% and a fund planner 1%, that's roughly $20,000 a year. If I'm withdrawing 5% or $50,000 annual, then the 2% I'm paying in fees on the gross 40%. All right, so I don't understand what he's saying. That's roughly $20,000 annually on the gross. If I'm withdrawing $50,000, then the 2% in fees on the gross is 40%. Well, no, it's not the gross 40%. It's the amount that you're pulling out, man. But you can look at it however you want. But yeah, if you're paying $20,000 in fees, it's not 40% on the. I think we're semantics here. But yes, you're paying $20,000 in fees. You're withdrawing $50,000. Thus, you're netting $30,000 after fees. That's 100% right. But it doesn't matter if you withdraw it or not. You're still paying the $20,000 in fees, man. There's no other way around that. So, you don't have to withdraw. You're still paying $20,000 in fees. You could withdraw $1 million or I should say $100,000, you're still paying $20,000 in fees. It's just, that's not debatable. I don't know what you're looking at wrong. I don't get it. But yeah, I mean, that's a hefty fee for sure. All right, let's look at R. Scott. Just retired 2021, 62-year-old spouse. Oh, 62 years old, spouse is 60. Prior to retirement, we were in the 24% tax bracket. My pension is 101. Wow. Adjusted taxable income. All right, so let's not use adjusted taxable income because it's adjusted gross income. Taxable income is different. So you just, I think what he's saying is AGI, his pension is 101, but his taxable income is about $79,000 after standard deduction, which means if I don't take Social Security early, we can remain in the 12% tax bracket. That is correct. I plan on waiting for my wife's Social Security to kick in, then we can both file. It seems we would have saved 10% from bumping to 22. Man, you guys got to write this better, man. I'm confused. Seems we could save 10% from bumping to 22 in the tax bracket. In addition, my Social Security would increase by 6% for each year I delay. That's actually 8%. I guess it's 7.5% until your full retirement age, and it's 8%. I can't understand what he's saying here. So I don't know what he's asking me. So look, folks, if you're going to write me a question, can you at least make it so I can understand? Obviously, this guy's on his phone or something. I don't know, but my goodness. All right, I just saved that. I didn't even look at it before I saved it. I should have just deleted it because it's embarrassing how poorly written that question is. And if you look, don't do that. It's just you're wasting my time. You're wasting your own time. If you can't take the time to think about it and make it so it's understandable, just don't bother. I hate to chastise people. Come on, man. Give me a break. So let's just look at what he's saying. So he's got $101,000 of gross income, AGI, and after standard deductions, he'll have $79,000 of taxable income. All right. So we have $101,000. So he can make, what is it, 110 or something like that of AGI to stay in the 12% tax bracket. I hope this makes sense. But you think, right? Because if we look at the tax brackets, hold on a second. Remember, this is his taxable income. He can make up to $83,000 and stay in the 12% tax bracket. And his tax bracket is 79. So he can take another $4,000 of income and stay in the 12% tax bracket. All right, so let's just say he takes $10,000 for simplicity. All right, $10,000. Oops, hold on a second.